Welcome to Analyzing Finance with Nick. We are going into another Iceberg series. This is the Iceberg of Wealth Management. Just as a disclosure, I am the partner at a wealth management firm called Spearhead Advisors, and nothing in this is investment advice or any promises for better returns. I am not a tax advisor, and I'm not an estate attorney. Do not use this Iceberg as advice about how to optimize your taxes or your estate planning needs. If you have any specific questions about anything involving wealth management, feel free to contact me directly, either via email or through the contact form in the pinned comment or the description, or through my website, nickpardini.com. And without further ado, let's get to the first layer. The first concept in the first layer is index funds. Index funds, I presume you guys are all familiar with. They're basically an investment that people can put a fixed amount of money in and buy shares of an index, usually through an ETF. The most popular index ETF is the S&P 500 ETF, ticker symbol SPY. And index funds allow investors to not make specific stock picks, but instead invest in the entire index. The most common way to do this is through the S&P 500 or the NASDAQ, but could also be done with other indices such as the Russell 2000, specific sector indices if you just want to invest in a particular sector and you think that is going to do well, but you don't know what's the best company in that sector. International indices out there for every country with a big enough stock market, foreign capital has an international index. Some are tradable via ETFs, others are not. And then you have indexes for all kinds of things. The main reason why this is the first one in wealth management, because it's become trendy among wealth advisors to give up on doing specific stock picks and switch to indexing. In my opinion, indexing works for certain asset classes in certain times of the market cycle, but other assets, you're better off trying to actually either pick stocks or invest in active managers. I'm going to get into the active passive debate later and the flaws of indexing too. But the main risk for indexing is overconcentration and the market becoming less efficient because indexes have gone from being less than of assets under management. So it kind of brings up a freeloader problem where in theory, people don't want to have to worry about beating the market, but they can just get the market return at the index. But if everybody does that, the market becomes inefficient because there's nobody out there competing to try to beat it. So that's kind of the dilemma with index funds. So it's a pretty simple concept. You can, for a low fee, you can buy an entire index of your choice instead of trying to pick individual securities. The next concept we're going to talk about are financial advisors. What is a financial advisor? A financial advisor is kind of an umbrella term that can mean just about anything. I've seen insurance salesmen call themselves financial advisors, private bankers, wealth managers, asset managers, financial planners, the modern version of a traditional stockbroker, and a lot of other things in between. So just because somebody says they are a financial advisor doesn't really help you very much of any idea what they actually do. The term originally came from the decline of high commission stockbrokers. You had full service stockbrokers in the 70s and 80s and before that, where if you wanted to trade stocks, you would call them and they would put on a trade for you and they would get a relatively high commission. Could have been up to $50 a trade in 1980s dollars. Adjusted for inflation, it's even higher than that. However, with the advent of the internet and discount brokers online, which first in the 2000s and early 2010s, it was under $10 a trade. And now with platforms such as Schwab and Robinhood and interactive brokers where it's $0 to $1 a trade, there's no way to make money as a full service stockbroker anymore. So a lot of these sales guys had to rebrand and offer a different type of service. They became financial advisors, which instead of charging on a per trade basis, have wrapped up into a single annual fee, be it discretionary
or a non-discretionary, depending on the advisor, broker for you, or a fiduciary. I'll get more into the differences of that in a different video, but the general idea is that's how the term came about, because the stockbrokers need to rebrand. A lot of other people have adopted it, and since it's because they've done such a good job of rebranding, anybody who works on the private client level in the investment management industry, whether they're the most high-end family office style wealth manager to a life insurance salesperson, is automatically labeled financial advisor. As I mentioned in a previous video, there's a lot of people who are either self-labeled or labeled by the general public as financial advisors, yet at the same time have very different roles in the capital markets and in the investment management industry. In this video, I'm going to talk about all the types of advisors and how you can differentiate between them. The first one I'm going to talk about are wealth managers. A wealth manager is somebody whose primary role is to manage the funds of affluent clients. So if you have $1 million nest egg and you want a professional person to manage it for you in a customized way, you can go to a wealth manager. But like a financial advisor, a wealth manager is a very broad umbrella too. A wealth manager really just can apply to anybody who's in the money management industry that works with individual clients versus institutional investors. So that, again, that could range from a more multi-product approach or to just a pure asset manager. So I'm going to differentiate that. There are general wealth managers, I call them wirehouse advisors, where they generally work for a big bank and provide not just wealth management, but also will provide ancillary financial services such as insurance and planning, and put it all together in one big package with usually a fee of a little bit over 1%. Independent practitioners offer these all-in-one packages too. Within these firms, often the investment side of that wealth management, but not always, there's some who do it themselves, is outsourced to an investment management team in their corporate headquarters of the bank or financial institution that is operating this wealth management firm, so that the local advisors can focus on asset gathering and relationship management. Then asset manager, on the other hand, is somebody who is more focused solely on managing assets. An asset manager usually doesn't do financial planning, or it's a very minimal part of their business. They do not offer insurance or tax help or some of the ancillary financial services that a more broad-based wealth manager would. And usually somebody would use an asset manager if they have other professionals who can handle those other things, or their wealth is high enough of a level that they don't really need to be concerned about financial planning. And so they want somebody who's more competent and specialized solely in getting better returns given the client's goals. That's the main difference I would say between an asset manager and a wealth manager. Yet an asset manager also is a wealth manager if they're dealing with private clients. There are asset managers such as big mutual fund companies and hedge funds who primarily serve institutional investors or have their entry through mutual funds or ETFs and are bought that way. But either way, whether they're entered through a mutual fund or ETF or serve only institutional clients, those institutional asset managers do not directly work with clients or provide customized separate managed accounts like a wealth manager would. So I know it sounds kind of confusing, but there are asset managers who are not wealth managers and wealth managers who are asset managers, but that's kind of the differences. The outside of that's within that, there's also the independent registered investment advisors. A registered investment advisor is a state or SEC registered firm that can legally take a fee for managing assets. They are oftentimes a fiduciary. A fiduciary has a higher legal standard for behavior, whereas a wealth manager affiliated with a wirehouse brokerage may have the standard of just putting clients in suitable investments. The fiduciary has a standard to work in the best interest of the clients and not have any inherent conflict of interests. The most common conflict of interest would be that a wealth manager or an advisor is being paid a commission to sell a particular financial product or a specific investment. A fiduciary investment advisor only has a flat fee they're charged annually on the assets, and they do not take any extra kickbacks or commissions. That's what differentiates a fiduciary RIA from a wealth manager who is affiliated with a brokerage firm or is not a fiduciary. And then the next one is financial planners. A financial planner is somebody whose focus is more on helping individuals manage their finances more than investing the funds. They tend to work more with upperly middle class people who have a harder time with budgeting, planning for retirement, saving for college, doing the math for retirement and other financial goals, and figuring out how to work with a client's income, previous assets, and spending patterns to build a plan to help them achieve their goals. It's a lot more relationship focused. It's a lot more building custom solutions on how to build the wealth versus managing existing wealth that wealth managers are focused on. You can be both a financial planner and a wealth and asset manager, but oftentimes people tend to specialize in their practices more towards one direction or the other. And then you will have private bankers, which are basically wealth managers, but deal with only high net worth and ultra high net worth clients. A private banker minimums at a big wirehouse is generally 10 million plus in assets. These private bankers often bundle in more higher end services that are more needed for their clients, such as legal, tax deferral strategies, estate planning, and access to alternative investments that lower net worth individuals may not qualify for. And it's just kind of, and it has just a more like white glove level of service and a smaller amount of clients. Private banker is basically equivalent of a multi-family office. I'm not really sure where the line crossed, where a multi-family office, how many families they take on before they become a conventional private banker or private wealth manager. But that's kind of the term. The other thing with private bankers sometimes too is they have closer relationships with the commercial lending side of things and can help facilitate those type of transactions, such as borrowing against a concentrated stock position and living off of those borrowed funds instead of selling the proceeds and collecting a capital gain. That's another example of a private banker type of service. And then there's estate planners. Estate planners are often attorneys, but they don't necessarily need to be. They help construct wills and other needs for trusts and other needs for estates, that when their clients pass away and their inheritors inherit those assets, it's done in a way that is tax efficient and as smooth as possible. I hear some CPAs and accountants classify as financial advisors, and their main role is to help individuals with their tax needs. And the last type of people who classify themselves as advisors are insurance providers, usually life insurance providers. There is some connection to the investment world, but generally insurance providers focus more on the client's wealth and savings needs involve needing insurance. And again, it differs on the person to person. And a lot of these insurance providers are also financial planners, because insurance is often part of a person's financial plan. Those dovetail well, and they're both more relationship focused, less analytical investment focused roles compared to an asset manager. It's more common to see a financial planner providing insurance than a financial planner linked up with an institutional asset manager. Overall, that summarizes all the people who can be classified as financial advisors. There probably are others that I'm missing, and if you'd like to know more about those, feel free to ask me in the comments. But I think I've given my viewers a general idea of the difference between a wealth manager, a financial planner, and an asset manager, types of people who generally fall under the category of being an advisor. Feel free to like, share, subscribe. Any support for the channel helps us grow.
The next one is 401k is kind of the standard employment retirement plan, what is known as a defined contribution. There's also defined benefits, which is a classical pension where the employer funds a pension 100% and they agree to pay you a fixed amount of income every year from your retirement to your death. However, just due to the unsustainability of pensions due to demographics, the business world in starting the 80s switched from a defined benefit to a defined contribution model where instead of guaranteeing a certain amount of money in retirement, employers will guarantee that they match the contributions of their employees. So if you put $1,000 in your 401k, your company will do so. And they usually have a maximum limit. The most common one is about 5 to 7%. So say you have a salary of $100,000 a year, the maximum you could put in with employer matching is $6,000. They'll put in another $6,000. So you get $12,000 saved every year versus just what you would have done on your own. There are maximum limits you could put in your 401ks regardless. The next thing we're going to talk about is emergency funds. The idea that you save a certain amount of cash in case you have a financial emergency, whether it's a job loss or a medical catastrophe or some other unexpected expense pops up that you need to cover and your income is not available to cover it. They call these emergency funds. Generally, the advice for emergency funds is anywhere from 3 months to 3 years, depending on the stability of your job, if you have plans of being an entrepreneur, your career goals, or your family expenses. Before you have cash to invest in the financial markets, you should first stock up your emergency fund so that in the event that you do have a job loss or some financial emergency, you don't need to liquidate your investment portfolio. The next one we're talking about is IRAs, or individual retirement accounts, are a self-directed tax favorable retirement account, whereas a 401ks are offered by employers. An IRA is self-driven. So instead of relying on an employer to create the platform for you, you have your own IRA as a tax structure. It's usually in the form of a specific account. In your brokerage account, you'll have a normal taxable brokerage account and a separate retirement account for your retirement money, which will be your IRA. There are 2 types of IRAs. There's a traditional IRA where you put in the money pre-tax, but then when you withdraw it, you have to pay taxes on it. But it's able to accumulate tax-free in the IRA, and you're able to contribute with pre-tax income. A Roth IRA is the reverse. It's after-tax income you contribute to the IRA, but you can take money out of it tax-free after it compounds. The decision on whether to use a traditional or Roth IRA depends on what tax bracket you expect to be in retirement than it is in your working years. You would rather be in a Roth IRA. And if you would rather, and if you think your income is going to be lower in retirement, then you would rather be in a traditional IRA. The other thing is with Roth IRAs, there are maximum income limit for a Roth. And the reason they do that because they don't want high income people just putting all their money into the Roth IRA and then having less income to claim for retirement from the government's perspective. And the max in 2024 is $146,000 for a single person and $230,000 a year for married joint filers. So if you're above, you can't even fund an IRA. But there are ideas such as a backdoor Roth, which I'm not going to really getting into this Iceberg, but generally that's the rules when it comes to IRAs. And the last thing on the surface level is diversification. Diversification is the only free lunch in investing is diversification. The idea of putting your money and a bunch of different things is going to offer better risk adjusted return than going all in a single asset class or a single security. And it's not, the people say, oh, I'm in the S&P 500. I am diversified. No, you're not. You're just 100% in US large cap equities. And even with that, 35% of that S&P 500 index is the top 5 biggest technology companies. And if you go to the top 10 companies, it's over 40%. So you're taking a lot of concentrated risk if you're just putting your money 100% in the S&P 500. True diversification is not just a bunch of different stocks of correlations. You got to find asset classes that are non-correlated. So that includes bonds, commodities, non-US stocks, stocks of different capitalizations like mid caps and small caps, alternative investments, or real estate. Diversification protects you from a specific asset class going through a out of favor down cycle or something structurally happens to impair the valuation. Whereas if you just happen to be in the one popular asset at the time, you may underperform. And it might look really bad for years and years, but over the long run, a diversified portfolio will usually catch up with a more concentrated portfolio with a lower amount of volatility and risk. Now, the next one we're going to talk about is the 4% rule. And the 4% rule is the idea is that a retiree can safely withdraw 4% of their income every year without ever running out of money due to investment returns and compounding. That's generally the safe rule of what you can pull out in a given year. I personally like the idea better that your max should be a little bit under the investment yield you get that year. You can not really tap into the principal, but you leave enough that the principal can go up with inflation and have some compounding. If you just take out your entire investment return every year, your principal eventually is just going to run out due to inflation. You'll need to take out bigger and bigger amounts. And unless your investment returns are consistently higher than inflation and there's no down cycles in the market, you'll end up losing if you pull out everything. So historically, the S&P returns about 7 to 10% per year, depending on what part of the market cycle you're in. And so 4% kind of gives you a safe margin of cushion to factor in the needed for the portfolio to catch up with inflation. The next thing I want to talk about are REITs. REITs are real estate investment trusts. A REIT is like a publicly traded way to invest in a large piece of property. So say you have a large Class A apartment complex and there's really not one individual buyer who can afford to take on the whole thing. The way you can participate is that they split the apartment complex into shares listed on the stock exchange, and you can buy those, and that is in the form of a REIT. The real estate is owned by the REIT, and the shareholders own different shares of the REIT. There are certain rules to REITs, like they have required payout ratios. They have to pay out 85 to 90% of their net earnings every year. You can't just retain it in the REIT. It has to be paid out in the form of dividends. And that's why REITs are generally valued not on their price earnings ratios or classical investment metrics, but on their dividend payouts and their free cash flows or the multiple to their dividend. And also real estate REITs cannot hold cash indefinitely. Like the REITs has to be invested in real property, which is like real estate. Whether REITs, most common form of REITs are in apartment buildings, commercial real estate, offices, and retail. And it's also data centers, farmland, and even single family home REITs exist now. It has to be some sort of hard real estate, has to be the underlying asset of the REIT. So that's simply REITs. And REITs may not have the same tax benefits as real estate, investing it in the conventional way, but they do offer more liquidity. If you want to get in and out of real estate and buy big Class A type properties that are not really typically available for individuals or smaller institutional investors. And it's usually not just one piece of property in a REIT too. A lot of REITs are a whole portfolio. So say like maybe one shopping center, you're going to have a whole portfolio of shopping centers across the country. Or instead of one apartment complex, you'll have a whole bunch of either in a specific region of the US or the entire country, even international. There's plenty of REITs that deal with overseas real estate too, if you want that kind of exposure. The next thing I'm going to talk about are 529 plans. 529 plans are basically a way that families can invest tax-free to pay for their children or grandchildren's college education. It's operates similarly to like a 401k or an IRA, but IRAs are more self-directed and you can invest in what you want. 401ks are usually limited to a set of investments based on what the employer permits. And then with 529s, they're even more restricted. They're usually these prescribed 529 plans, and they're different depending on what state you live in. Each state has their own like approved 529 plan, and some of them, and a lot of this, and there's certain reasons why you would pick one state or another depending on where you live. But with 529 plans, it's usually like these prescribed limited investment options, and they're usually like target date portfolios that will target when the child that you're putting the money in is going to be ready to go to college. The advantages for this is, again, it's tax-free. The disadvantages are it's very limited on your investment selection, and the money has to be used for education costs. If you put too much money in the 529 plans and you don't spend it on education-related expenses, when you do withdraw that, you're going to pay tax and possible penalties. So that's how 529 plans work. And then the other things I'm going to talk about is active versus passive. This is one of the main debates for wealth management and investing. Do you put your clients' money into active management or passive management? Active management is when the advisor is selecting specific investments, whether it's securities or alternatives or bonds, or hiring an active manager through a fund to do it for them. Passive is putting it in a blind index and not doing anything, just staying in the index. I talked about passive and the benefits and drawbacks of it in the index fund, but the main debate here is, should you actively manage assets or be passive? There's advantages to both. The advantages to passive is that it requires a lot less work. You have whatever the market rate of return is in a given asset class that the index is built off of. There's also, oftentimes, they might be lower fees, so it's less expensive. And then if you're an advisor, you could focus more on business development and other sides of your business because you're not really having to worry about investments because you just have a fixed passive model that will allocate to certain things and take care of itself. The main disadvantages of passive is excess concentration, poorly constructed indexes. An example would be the Russell 2000. The problem I have with the Russell 2000 is that you have the best companies get promoted to the mid cap or the S&P 500, and the worst companies of the larger cap indexes get kicked in to the Russell. So as a result, there's a negative selection bias. It's like being the third tier league in like the English football pyramid. So you're not, whereas with the S&P, the best of the small caps move up and the worst get kicked out. You have the opposite negative version of that affecting mid cap and small cap indices. And then there are certain other ones where like emerging market countries, the indices are heavily weighted towards inefficient state-owned enterprises, or certain countries' indices are flawed because one company is a large portion of their economy, like InBev for Belgium or Novo Nordisk for Denmark. So you have to look at the methodology of the indexes and can't just blindly assume it's a great way to get the kind of exposures I want. And also just the dynamic change in the market, certain things in the index might make sense or might not make sense. Even choosing which index to use, like say, for example, you buy the equal weighted S&P 500 versus the cap weighted S&P 500. Even though it's technically choice between two passive indexes, you're technically an active investor by choosing one or the other. Truly passive means you just have an all-world, very directionally or asset class agnostic outlook, which is not really in the best interest for most investors, especially those whose assets are large enough where diversification really makes a difference. The last two concepts are a fiduciary and a custodian. A fiduciary is really the idea that most registered investment advisors, such as my firm, are fiduciaries. The advisor is obligated to work in the client's best interest. With a broker, they are more suitability. They just can't willingly put you in something that they know is bad for you. Whereas a fiduciary has a higher standard. They got to do what's in best interest of their clients. They can't really factor in things such as kickbacks from fund providers to the advisor or other business interests that are not really in line with the best interest of the client. So that puts fiduciaries at a higher standard than other advisors. And if you are looking for an advisor, I recommend picking a fiduciary so you know that their best interest, and their fee structures often reflect that. A fiduciary usually has a flat fee for assets under management, or sometimes has a performance-based compensation. With a performance-based fee structure, the manager is willing to take excess risk because they don't get paid unless the returns are above a certain level, and they get paid more the higher the returns are, but they don't take any of the downside if the portfolio drops. So they have less incentive to be defensive on their investments and more incentive to be overly aggressive. But fiduciary generally means that they have to be aligned in the best interest of your clients. And the last one for tier 2 is a custodian. A custodian is the platform that holds the assets. An advisor is somebody who manages the assets, whereas a custodian is the brokerage most of the time, but it could be a bank or somebody else who takes custody and actually holds the assets. In the old days, it'd be in their vault. Nowadays, it's like a digital platform. Example would be like with my firm. My firm, Spearhead Advisors, is the fiduciary and the active investment manager, whereas Schwab is our custodian. Schwab is the one physically holding the assets. The wealth manager is not holding the assets. In some bigger banks, they are their own custodians, but generally there's a custodian separate from the advisor. This is generally a positive thing because it prevents things like what happened with Bernie Madoff, because there's protections built in with having a third party as a custodian. Next, with level 3, this is where it starts to get deeper beyond the surface kind of level stuff that we talked about in the first 2 tiers. First one is a family office. A family office is an investment firm that manages the money solely of one family. It's usually an ultra high net worth individual who earned the money through starting a business or inheritance, and then builds out a staff independently to manage the family's assets. This could be in the case of a new money family office. A founder has a liquidity event, sells their company for hundreds of millions of dollars, and now needs to deploy the capital. The owners of the family office are the founder of the wealth and the future estate, which is usually spouse and descendants. Old money family offices have been around for generations and often come in the form of a foundation where they manage the money of the same family, but the original founder who made the money and set everything up has been long deceased. There are also multi-family offices, which are family offices that are not owned by a single family, but serve a few select families in the same capacity as a single family office. So why would somebody want to set up a family office versus hiring a financial advisor to manage their money? Less ultra high net worth individuals often go to a private bank or a wealth management firm, and for a fee on assets, usually about 1%, the financial advisor or the wealth management firm or the private bank will manage the money for them and allocate it across whatever asset classes they feel make sense. The reason why you would create a single family office over hiring an advisor or having your money managed by a private bank or wealth management firm is due to economies of scale. When it comes to a high net worth rich person, as I mentioned in my video how much money it takes to be rich, let's say they have a net worth of $20 million and you are paying 1% on that. That is about $200,000 in fees. If you just not negotiated lower, these clients tend to be able to have a lot of bargaining power. Is not enough money to finance a single family office. If you want to create a single family office, there's a lot of expenses that go into that. You first would need to hire a CIO, and a CIO is probably going for about $400,000 to $500,000 a year at minimum, including bonuses. Then you're going to need a competent analyst to work with your CIO, and that's going for anywhere from $100,000 to $200,000 a year at minimum if you want a good one. And on top of your lean staff of 2 investment professionals, you don't have any back office or operations professionals, or that's all outsourced for a reasonable cost, then you're still going to need to buy a Bloomberg terminal, which is going to be about $30,000 a year. There's going to be other trading technology tools that probably in the outsourcing of the back office operations side of your family office. It's not as much compliance because if it's a single family office, you don't need to register with regulatory authorities because it's viewed by regulators as just a family managing their own money. So it's less than it would be if you were advising money for multiple families in terms of compliance costs and regulatory costs, but there are still other back office things that need to be done to keep everything organized. And let's say that all of that combined is about $10,000 a year. If you add all of that up, you're going to be spending a minimum of $550,000 to $1 million a year on operating this family office. If you have bigger investment staff or other resources, maybe your family office manager needs to go travel to go due diligence on a privately held company that's outside of your hometown. That's a cost. But in general, let's say the expenses are about $1 million a year. So if you have $1 million a year in operating expenses for a family office to be set up, then in order for the family office to make more financial sense than hiring an advisor, your net worth is going to have to be well over $100 million. That $100 million, a lot of advisors will work for less than 1%. The cost of hiring your own staff, and then it's not just financial costs, but just the probably additional headache of having to build a whole business within your family just to manage your family's assets could create a lot of stress and other personal headaches. It doesn't make sense for those ultra high net worth individuals who have less than 9-figure net worth to do it. And even if it makes financial sense for some of these bigger players to have a family office, it may not make sense for other reasons. Before I go into how family offices are different outside of the fact that they manage just a single family or a small group of families' money, I'd like to update you and remind you to, if you like the content of this channel, to please like, subscribe, and share and have engagement with what we're doing. The more involvement this channel has with people engaging with the videos directly or sharing it with others, the more it grows, the more it gets out there, and the ideas and the concepts that we try to educate people reach more people, which is my goal. And it motivates me to make more and better content and improve content the more people watch it. With that, let's get back to family offices. Outside of the fact they often serve the single or small group of families, family offices are different in the way they can approach investments. Since they are only focused on one family, and usually those families' goals are multi-generational, they have a lot more flexibility in their investment mandates. If you're managing money for somebody who's going to spend all that money in retirement, you can't really take the same risks as somebody who has a much longer time frame. And if you work at an institution like a hedge fund or mutual fund, you often have more strict mandates that restrict what type of investments, whether it's certain types of stocks, only a certain asset class, or you can only go long a certain asset class or short a certain asset class. Or there's usually hard mandates that limit other types of investors from having a more gestalt approach that family offices have the luxury to do. That's why a lot of investment professionals like to work at a family office, because they can have a more long-term approach, like 5-10 years plus out. They have a lot more flexibility in the types of investments they can do. So It kind of fulfills an intellectual curiosity to put your hand in a bunch of different things. And on top of that, they're not as concerned about shorter term performance because the money isn't needed right away. And unlike mutual funds and hedge funds, who as investors are more into chasing performance in the short term, it's often more job security for people to work at family offices, and they can take more longer term time frames. Because you have a down year as a hedge fund manager or even mutual fund who underperform the benchmark for a couple of years, your assets are going to disappear rather quickly. And the volatility of asset flows in more institutional investment firms creates a lot more job insecurity and stress to deliver now. And so therefore the time preferences of investors at these firms is shortened. Whereas with family offices, they have the luxury of having a much longer term time frames. They don't have to deal with those market forces that institutional investors have to deal with. And so that answers the question why a lot of people like to work at family offices. And the reason why most investment professionals want to eventually start a family office, not because they have a particular passion for this style of investing, but it's just proof that you've made enough money that you can not only retire yourself, but your family for the next few generations. Family offices are starting to become a status symbol among the ultra elite, because if you have a family office, it means you have enough money where a family office makes sense over hiring a regular investment advisor. A family office also has the benefit for families that it can be a source of employment for descendants. If you want your family members to have a cushy job and a nice living standard without having to go through the grind of working in institutional finance or work long hours and have the luxury to still live a life of leisure but still nominally hold a job, you can put your child in the family office once they graduate from college, and they have the perception of being a productive, gainfully employed society. But as the patriarch or the matriarch of the family, you can decide whether they need to work that hard or not. And then I'm not saying that family offices are just the land of spoiled children. There are plenty of people who manage family offices who are from the family or are hardworking. They just were passionate about finance, and they're like, why bother working for somebody else and growing their wealth if I can just focus on my family? But it does give the opportunity as an outlet, as I've mentioned in some of the David Graeber videos, to place somebody in an upper class job without a lot of demands. So that's another perk of a single family office. And then the other perk is lack of transparency. If you're having money with an institutional investors have disclosed their assets. You're also, they don't have to say who their clients are, but at the same time, your money is going to be held at a third-party custodian. And so there is a paper trail that can be seen. And if you're an outside advisor, there's a third party who can see your personal records and your asset and its liabilities. And if you would rather not have that and just keep everything in house and only hire family members to manage the money, you can have a lot more privacy than you would if you put your money with a professional advisor outside of the family. Privacy is the other advantage of family offices. So where do multifamily offices fit in? Multifamily offices provide a little bit of the best of both worlds. They provide a lot of the bespoke touch that a single family office could provide if you were hiring outside professionals and not having family members manage the money directly. However, they can probably do it also at a fraction of the cost of a single family office itself. If you have a multifamily office that works, say, with 5 families, each family only has to kick in 20% of the costs of operating the family office versus having to do it all themselves. That would allow lower, relatively speaking, net worth individuals to participate in the family office game, like those with high 8-figure net worth versus the $100 million plus club if they wanted to. The downside of multifamily offices is that effectively they're very similar to a more sophisticated financial advisor or wealth management firm where they have multiple clients. And what they are doing is often has to take into consideration of others, maybe in terms of priority of trades. They can't prioritize buying. If you think it's a good idea for all of the families you work with to own the same stock or asset class, they can't prioritize your family getting the shares versus another family. And then there's also the lack of privacy issue. These multifamily offices tend to be owned by people outside of the families involved. As a result, like any other outside business, you have your assets managed by a third party, and third parties can see what your net worth is or your financial assets. And usually customers give and investors give transparency to their advisors so they can make the best decisions for them. So that's the main downside of a multifamily office relative to a single family office: less control and privacy, but at lower cost. The question really is, what's the line between a regular wealth management firm and a multifamily office? A multifamily office does sound a little fancy, but in theory, like, isn't every wealth management firm a multifamily office theoretically? I don't really know what the cutoff is. I've done research on it. I guess a couple dozen families maybe your top, but there are exclusive wealth management firms who really only work with that many. I think the only true family offices are the single family offices. The next thing is FIRE, which is the abbreviation for Financial Independence Retire Early, which is the idea that if you save enough of your income and live austere enough post-retirement, you can save enough money that you can retire very early and not have to work. By example, it'd be like tech workers who are making $300,000 a year and keep their living expenses down to say like $30K a year, maybe like by living with their parents or eating ramen every day or whatever. And they after tax are taking home $120,000 a year. Compound that in investments, that can get up to about $1 million, and you can, at a 5% return, have 50,000, and you could live off that. So if rule of 72, that your money takes about 7 years to double, and you're taking home, say, like 100,000 a year, you can probably retire in about 7 to 8 years if you're willing to live a simple lifestyle. The main disadvantages of FIRE is, one, your life's probably miserable living super austere the whole way up. Two, you're not guaranteed to live long enough to enjoy that retirement. Or three, there's a real risk that either due to high inflation or down years in the financial markets, that money may not last as long as you think it does, and you might have to go back to work. It probably precludes you from having children because the cost of having children is far more expensive than most FIRE budgets. And there are more ways that people want a more comfortable life and do FIRE, and they might take a little bit longer to save. It's called Fat FIRE subreddit as an example, but really I think of Fat FIRE as more just conventional retirement and doing it early, whereas I think of FIRE as more doing all the extremes you can to get out of the job market as fast as you can. And the next thing we are going to be talking about are Bogleheads. And Bogleheads are named after John Bogle, the founder of Vanguard. And it's the idea that people are dedicated to the idea of indexing, and that conventional investing is a waste of time. Active manager and wealth advisors are a grift. And they just are all in on just passive due to low fees, and that nobody can really beat the market over the long period of time. And they have a lot of message boards and a very active internet community all discussing this kind of thing. The next thing we're talking about is tax loss harvesting. Tax loss harvesting is the idea that you have investments that you can use the losers to shield some of the tax gains from your winners. So say like the capital gains tax, for example, is 15% in your bracket, and you have a stock that is up 100%, and you have another stock that is down 50%, and you invested $2,000 in both of them. You need to sell both of them to pay for your wedding. Instead of just selling them evenly, you could sell all of the loser and take the tax loss, which is $1,000, and sell half of the winner and your capital gain on that half is 1,000, and that is canceled out by the capital loss from the loser. So you have zero tax liability because you use the losses to offset the gains. This is how a lot of portfolio managers help their clients become more tax efficient. So it's the end of the year and you have a generally successful year when it comes to returns across your portfolio, but either your clients have liquidity needs or you want to get out of a certain stock because you think that it's become overvalued because it's rallied so much. What you can do is sell the thing you want to get out of, and you could sell the biggest losers against it in order to minimize tax liability. It may not completely add up and you might not have enough losses to cover all the gains of your winners that you're selling, but it will help reduce the tax burden. And also, if you do need liquidity, but there's nothing you want to sell, you can prioritize selling the losers, or at least enough of the losers and to be matched by some winners that there's no net tax liability from a capital gains perspective. There's even algorithms that do this for a lot of robo-advisors nowadays, so it's a very common practice. Next one is fees. Fees are how investment advisors get paid, or even ETFs, like indexes even have fees. And it's usually a flat annual fee on the assets under management. Different advisors have different rates of fees. Different ETFs have different levels of fees, and mutual funds too. There used to be a lot of other types of fee structures, such as loads and wrap fees, but those have become less popular over the years in favor of, like, for active advisors, like it's a straight fiduciary fee, active management fee. Or you have, in the case of indexes, just a flat fee on the ETF or the mutual fund. It's anywhere from, on the very low end, like 20 basis points for a simple index fund to 2% or more for the most exclusive hedge fund managers. Most typical advisors charge about 1%, and most mutual funds are anywhere from 0.5% to 1.2%. There are plenty of funds and advisors who are above or below those levels, but that's just a ballpark.
So how do money managers actually make money? What are the economics of the investment management business, and how do financial advisors get paid? Most managers make money on a flat fee basis, which is usually a fee as a percentage of the client's assets under management. So say if you're running a $10 million investment advisory practice and you charge a flat 1% fee, then the advisor is going to be making about $100,000 of years in fees. And that is deducted either monthly, quarterly, or annually. It's prorated, either 1/12 or 1/4 of the annual fee over that time. And there are some advisors that will also do declining fee balances for larger accounts. So say if you have one client with, say, only $1 million in the advisor's managed account, it'll be charged 1%. But if somebody put $10 million in it, they'll give them a discount and charge only 0.6%. The reason you do that is because the amount of work at 1 million versus 10 million is more because there's more complications with more money, but it's not proportionately more. So also that fee goes up with the size of the account. 0.6 of 10 million is still a lot more money. In this case, it's 0.6 of 10 million would be 600,000. No, it'd be 60,000, sorry. It would still be a lot more money than 1% of $1 million, which is about $10,000. And on top of that, that fee is compounded. Every year, the advisor makes that 1% fee. And the incentive is lined up with the clients this way. If the value of the balance goes down due to a bear market or the advisor not making good investment decisions, then that fee amount also goes down because it's proportionate to the number of assets in the account. For AI and simplistic type financial advisory decisions, you're seeing some firms switch to a flat hard dollar fee. They'll charge $2,500 to either build a financial plan or to allocate the client's portfolio to a model that doesn't change. A lot of people in the industry are afraid that's going to spread to more personalized portfolios, but the scaling doesn't work because it wouldn't pay enough for an advisor to be worth participating versus getting other job opportunities on the institutional side of the business, smaller portfolios. And larger accounts, need more customized solutions that cannot be built by an AI or a model. The ones who try to do that could make some money in the short term by running a high volume business, but they risk alienating their clients in the long term due to lower service quality. The other type of payment structure is an incentive fee or a performance fee or a carry. This is generally restricted to accredited investors and applies more to hedge funds and private equity managers and not to traditional wealth managers because of a lot of the restrictions involved with it. And with this kind of structure, you get paid a larger fee, but only as a percentage of the profits. So if a hedge fund is charging 2 and 20, which is the classic payout structure for them, they have a 2% fee on the assets, which is in this case, let's use $10 million for the example, would be 200,000. And then you would also get a performance fee. So let's just say that 10 million goes up to 12 million and you charge a 20% performance fee. So you'd get paid 20% of the 2 million in profits, which is $400,000. The hedge fund manager in this case would take home about $600,000, 2% from the 10 million on the management fee, and then 20% of the carry. And so this aligns the incentives even more. There are even some advisory firms that will pay 0 and 20 or 0 and 30, and they'll just go all in on the incentive fee. The management fee is really, for most hedge funds and private equity, just the charge just to keep the lights on, metaphorically. And they pay themselves the bonuses and big payouts on the incentive fee. A lot of adjustments can be made to this, such as advisors having a hurdle rate, which is a minimum rate of return before the performance fee kicks in. If you're a client, you go, hey, wait, why doesn't this guy just put it all in the S&P? The S&P average is about 8 to 10%, and he just collects a huge performance fee for doing nothing. For example, a large cap equity hedge fund manager, they may put a hurdle rate of whatever the S&P is and charge only a performance above the hurdle. Often, if there is a hurdle, the performance fee is probably higher than if there was no hurdle. But that's kind of what can be put in to protect from that possibility. So overall, fees are straightforward. They're either a flat fee, a percentage fee on the assets, a flat cash fee to set up a model portfolio, or a flat fee plus an incentive fee for more speculative investments such as hedge funds, private equity firms, or real estate collectives. Estate planning is the idea that you need to manage your assets and your wealth to be able to be transferred down to the next generation in the cleanest and most tax efficient way possible. Most problems with estate planning really aren't even tax related. They're more to do with dealing with the messiness of inheritance. So for example, you have, and I've talked about this in the Great Wealth Transfer video if you want to go more into details of what's going on in the world of estate planning. But if you say, for example, are some older parents and you have 3 adult children who don't like each other, you need to build a well-defined will and estate plan that prevents all the money from being wasted on your children litigating each other because they don't think that the inheritance is fair. If you don't have some sort of estate plan, you go into probate if the estate is more than a certain size. In California, I think it's about $184,000. And probate is very expensive, and it becomes very ugly, and it's a lot of time wasted in the court system. So it's generally a good idea if you have any meaningful sorts of assets to have some sort of estate plan, which is usually a mix of a will and a trust and a variety of other provisions that make sure that who is supposed to inherit the money, do it in the most tax efficient way possible. The next thing we're going to be talking about is trusts. A trust can be a lot of things. The most common thing when people think of trusts are trust fund babies, or the idea of people who are so rich they can just live off the assets of a trust. But what is a trust exactly? A trust is the main kind of legal document that an estate planning attorney will construct for you. What it does, it's a legal entity. There are a bunch of different kinds of trusts. First, they can be broken down by control or revocability. A revocable trust is a trust that can be changed or revoked by the grantor during their lifetime, often used
for estate planning to avoid probate. The other thing you have is irrevocable trusts. A trust that cannot be changed once it's established. It offers asset protection and estate tax benefits. The reason why you want to make it irrevocable is so that it doesn't count as the assets of the grantor who is passing away, so there's an estate tax benefit to it. And also, if it's an irrevocable trust and you have some sort of issue, whether it's a lawsuit or a divorce where somebody tries to claw out of the irrevocable trust, they can't do it. The money's in the trust and it's stuck there. A simple way to explain what a trust is, it's a legal arrangement where a trustee holds and manages assets on behalf of beneficiaries. And it's rules set by the grantor of the trust to control distribution of assets, protect wealth, and minimize taxes. And there's a lot of stipulations you could put on trusts. I might go into more of these deeper into the iceberg for details, but there are trusts that are designed to help pass money down different generations. There are enough trusts to protect the people who, either the grantor or the beneficiary, from other forces that might take away the asset, or trusts that are used to be more compliant or estate tax efficient. Well, I'll get more into types of trusts in terms of the purpose and function beyond revocability deeper into this iceberg. Private placement life insurance is a customized, institutionally managed life insurance policy that is designed for high net worth and ultra high net worth individuals to shield investment growth income and capital gains taxes, and allowing for tax-free withdrawals and wealth transfer. So instead of putting your money in a regular brokerage account, you buy a private placement life insurance policy and you use your funds to self-fund the policy. If you do that, you can get tax-free growth and withdrawals on that money if it's structured properly. It allows you to compound your investment returns without having to pay taxes in a more conventional way. And it also often avoids estate taxes if the private placement life policy is placed in a trust. It has a lot of asset protection because it's in an insurance wrapper. The main downside is just the cost of setting these things up tends to be rather pricey. You need to have either a very high amount of assets, generally say like 10 million plus USD, or a very high level of taxable income, or both, for it to make sense. Like if you're making less than say 700,000 USD a year, it's not really worth considering private placement life insurance due to higher costs and higher interest rates, which makes life insurance more expensive. You're going to need maybe more like $1 million a year in income and about 10 million plus in assets to make this really an efficient means that it's worth the cost of setting up. However, it is an option, and it is a way that higher net worth liquid individuals can be more tax efficient with their investments. The next one is Dynasty trusts. And we're going to go into all the specialized trusts here. I didn't write them all down, but there's several types of specialized trusts. Dynasty trusts are ones that are designed to live longer than any of the grantors or beneficiaries. So they could perpetually pay out certain fixed amounts to different generations of a wealthy family. These are most popular with old money families or new money families who want to become old money families by making sure everybody is fully provided for. Since the trust owns the asset, the beneficiaries don't have to pay estate tax. Instead, the assets in the trust, whether it's a stock portfolio, real estate, or bond portfolio, will continually pay the payouts to the beneficiaries of each generation as it was intended and written in the irrevocable trust to set this thing up. So that's kind of a very common form of trust. The other one I'm going to talk about here is a charitable trust. Charitable trusts pay income to the beneficiaries, but then once the beneficiary dies, they donate the remainder to charity. There's special needs trusts, which provide disabled beneficiaries without disqualifying them from government benefits. They're asset protection trusts. They're designed in a way that the trust owns everything. A human owner who originally owned it does not have legal ownership. So in the case of a divorce or a lawsuit, those assets cannot be claimed by the plaintiff. A blind trust, which is very common for politicians, and it's why a lot of very high net worth individuals want these cabinet positions. It is a trust where you have to put your assets managed in a way without the beneficiary's knowledge, and you usually sell whatever you have. You could sell whatever you had before and put it into this trust without paying capital gains if you're appointed a cabinet. A lot of people with low cost basis but very valuable assets want to have cabinet positions for this very reason. But and the reason why the cabinet does this is because of conflict of interest. If you have a member of the cabinet who owns a bunch of stock in the industry they are assigned to regulate, so say like the Department of Energy head owns a bunch of stock in Chevron, they're not going to be working in an objective manner about how they regulate Chevron because it's in their best interest not to. So you either need to sell it or put it into a blind trust so that the person with the conflict of interest cannot trade on it. And there's probably private sector's examples of blind trust, but this is the most common, really, example. And then there's testamentary trusts, which are trusts that only take effect after the grantor's death. And then the last one I want to talk about is a spendthrift trust, which are also very common among wealthier families who want to set these up to protect descendants or heirs known to have financial irresponsibility or bad spending habits. It's a trust that disqualifies the beneficiary from reckless spending or creditors. For example, if it's inheriting real estate, it prohibits the beneficiary from taking a mortgage on their property. Or if it's a stock portfolio, it prevents leverage. It only pays out a fixed allowance every month, and there's no way you can borrow against it, so that the irresponsible heir cannot spend themselves to bankruptcy. And a lot of old money families, like I think the Phipps family is a notable example of this, at least based on the video I saw from Old Money Luxury. They set up these trusts and to design them in a way that the beneficiaries cannot spend themselves back into poverty. So if you have a son or a daughter who you don't trust to be financially responsible, instead of giving them a straight inheritance, you should put their inheritance in one of these spendthrift trusts. Alternatives are any type of investment that doesn't fit in classical security analysis, which is generally stocks, bonds, options, futures, or listed derivatives. Some people consider real estate to be a traditional investment. Others think only REITs are considered a traditional investment, and real estate that's more directly held is considered alternatives. But alternatives is basically the bucket for everything else. This includes hedge funds, venture capital, private equity, crypto, commodity trading advisor funds, futures, which generally some people think is alternatives, some people think is traditional investments. It really kind of depends. This could include specialized structured products and just pretty much everything else, option strategies, basically anything else under the sun that doesn't really apply to conventional stocks and bonds. And alternatives have become more popular over the last few years due to perceived outperformance on a risk-adjusted ratio and opportunities for greater diversification. Collectibles would also be considered alternatives. 1031 is the idea of having more tax-efficient real estate investing. A 1031 exchange is if you buy a piece of property, you can sell up the piece of property without paying any capital gains tax if you buy another property of equal or greater value. So the reason why this is built in is because, say, like, for example, if you're like a normal middle-class family who buys a starter home and then they have more kids or their income goes up and they want a bigger house, they oftentimes have to sell their old house to be able to afford to buy the new one. And you don't really want to tax families capital gains tax every time that they sell their house to buy a new one. Otherwise, you would have a dead housing market. And so that's what the 1031 was placed to allow people to like trade up or trade down in their properties without taking a tax hit. However, if you do trade down and have any excess cash, anything above the limit, which I think is about 500,000, is eligible for capital gains tax. So keep that in mind. But yeah, that's how a lot of real estate investors can compound their investments without paying tax, because they just sell their current real estate to immediately buy new real estate. The next thing I'm going to talk about is leverage. Leverage is the idea of borrowing money to increase returns. This could be through having margin on your account, which means that in addition to the amount of cash you have, you're also borrowing funds to buy securities. You can have leverage indirectly through futures contracts or options contracts. You're trading more assets than you have cash in your account. That is leverage. And leverage on the way up works great because you get more returns. Like example would be like, say, example, you have 2-to-1 leverage on a stock and the stock goes up 20%. The stock might have gone up 20%, but the value of your account went up 40 net of interest costs. Well, because you're at 20% is of the whole portfolio is 40% of the cash you put down. But this also works the other way. It's a double-edged sword. So if the stock goes down 20%, your portfolio of your asset value goes down 20, but your equity value, which is the amount of cash you have, goes down 40. So leverage is a double-edged sword. The last concept we're going to talk about in tier 3 is the Sortino ratio and also the Sharpe ratio. They are a way to measure risk-adjusted returns. It's how institutional investors and advisors grade how effective an active manager is in getting alpha or return above just what they would have done in the index in their asset class. The formula is pretty straightforward. The Sharpe ratio equals the return of the portfolio minus the risk-free rate, which is usually the equivalent of like a treasury bond, and divide that by the standard deviation of the portfolio. The higher the number, the better it is. The flaw really with the Sharpe ratio is that it doesn't really factor in upside volatility as being better than downside volatility. So if you have a lot of upside volatility, that increases the standard deviation and therefore lowers the Sharpe ratio. The Sortino ratio adjusts for this. Instead of using standard deviation, it only uses downside volatility, so standard deviation of drawdowns. And so as a result, it measures effectively more the downside risk than just the general standard deviation of the portfolio. So it's the same formula as the Sharpe, except replace general standard deviation with just downside standard deviation. And generally, a Sharpe ratio above 1 is considered good, 2 is very good, and above 3 is exceptional. Welcome to the next layer. We're now layer number 4 in the iceberg of wealth management. As a disclaimer, nothing here is investment advice. Do your own research or hire an advisor. Also, I run a California-based registered investment advisory firm, Spearhead Advisors. I come from that perspective of somebody who does this for a living. The next one is bank sweep. A bank sweep is when a custodian will sweep extra cash overnight and put it into short-term securities to collect an interest rate on it, and then put the cash back into the account the next trading day. Since brokerages can't really make money anymore through commissions like they used to, at least for most things, like certain options trades still have commissions. In general, commissions have been largely eliminated. Payment for order flow is still a thing, but it's gotten more scrutiny and is not as lucrative as it used to be. The main revenue source now for brokerage accounts or companies providing brokerage accounts is bank sweeps. If you have a $1 million portfolio, you have 900,000 of it in securities. The remaining 100,000 is in cash. That cash will be swept overnight into short-term securities that the brokerage will collect the interest rate on, and you don't get interest in your brokerage account, but the interest on whatever cash reserves you have will be collected by the custodian, which is how they are able to keep the lights on. So that's what a bank sweep is. The next thing is borrowing against stock. This is a common criticism that a lot of wealthy people, particularly those who own a lot of stocks, get. If you're some tech entrepreneur and you start a big successful tech company, you don't want to sell your stock because you don't want to pay capital gains tax. But at the same time, you want to have the liquidity of living a rich man's lifestyle. Even if you don't have the cash from profits of your company, or from selling your stock to finance things such as buying a mansion or a nice car or vacations or a wedding. As a result, you can borrow shares from a bank. Usually it's the bank that you do your wealth management through, or the custodian of the wealth management firm you work for, but it could be a different one as well. You can use the money you borrow against your shares for your lifestyle, and you have to pay it back with interest, or it could be structured as interest-only loans. The collateral on these loans is the stock you hold in your brokerage account. If you have $1 billion worth of stock in your company and want to spend $250 million to finance your lifestyle, you can borrow $250 million from the bank, pay the going interest rate for this. Let's just say it's 10% per year. You have that money and you can use it for whatever purposes you want, but you have to pay back that 10% every year. However, that 10% interest rate is lower than what you would pay in taxes. Because let's say if you sold that stock, you're in the max bracket, so which is 24.8% if you plus any state and local taxes on capital gains in your state. You save money. Instead of paying the tax on that, you're paying just interest. The difference is that if you pay interest every year, that eventually might be more than the capital gains tax. For most of the ZIRP era, the spread was much more attractive. You still had the 24% capital gains tax, but maybe because of ZIRP, that interest rate instead of 10, like in my hypothetical example, is maybe somewhere between 2 and 5%. And so it made it a lot more appealing to borrow back against your shares. And the lender's fine with doing this because they have $4 of stock for collateral for every dollar. However, usually there's a stipulation in these loans that if the stock goes down by more than a certain amount, which is defined, the borrower gets margin called and they're forced to sell the stock to cover the loan. That's often why you'll see a stock go way down for non-economic reasons, and you see a bunch of selling. This is common with new IPOs sometimes. It's not always the case, but it's oftentimes a lot of people having to sell to cover loans against their shares. And it has to be more, obviously, that this more than the loan amount because they have capital gains tax to pay and they have to pay that loan back after tax. So that's the ugly side of this. But if it's a more stable stock you sell low enough of it as a percentage of your total equity, it's fairly safe. The next thing I'm going to talk about is syndications. And syndications are basically offers to pool groups of private investors to invest in specific alternative investments. Usually it's real estate, most common for buying like an apartment building or something like that. But you also see like syndications for like venture capital or private equity deals or private credit loans. But it's kind of just like you have a guy who provides a deal and he needs a certain amount of money, but doesn't really want the entire world to have to invest in it or do a formal securities offering. Instead, he'll have this network, it might be simple as an email list, and be like, hey, look, I have this deal. If you're interested, how much would you want to chip in? This is the total amount we need to raise. And then you have an operating agreement, and voila, you now have a private deal through a syndication. So that's what a syndication is. Speaking of private deals, private equity is the next one on here. Private equity is shares of companies but are not publicly listed or buying out entire companies. There's multiple ways you do private equity. The most common way is a leverage buyout, which I talked about in the Iceberg of finance, where you borrow a bunch of money to buy out a company and cut the cost to pay back the interest. There is just growth equity, where you're just trying to buy a company you think is going to grow and it's not public. And so you just, even if it's less levered or unlevered, you can still buy privately held companies. Or there's venture capital, where you are giving money to entrepreneurs to get started on their companies. So all of these are different forms of private equity. It's illiquid, but the difference really is that private equity has the same risk profile as a small cap value stock portfolio, but it doesn't have the same amount of reported volatility. And so that's why it's attractive to a lot of institutional allocators. The next thing I'm going to talk about is deal flow. And deal flow is really just the amount of deals that are being sent. It's just the list of private deals, whether it's private credit, private equity, real estate, venture capital, that's being sent to institutional investors, wealth managers, or high net worth individuals to invest in. Usually people who have better deal flow tend to have better returns. That's why venture capital returns tend to be so skewed to the top 8 firms. They get the cream of the crop deal flow. They get the access to the top startups before everybody else generally. Whereas by the time it goes down to the mass level, a lot of the best deals have been picked off. And so like a major edge, if you're an alternative investor, in terms of getting real alpha in this space, is finding good sources of deal flow, whether conventionally or unconventionally. If you don't have as good deal flow as some of the big institutional players, you can't really expect to outperform them in the long run unless you're better at finding the diamonds in the rough. But deal flow is really just kind of the key to alternative investments. If you've got deal flow, you just have more opportunities. Most people in alternatives, particularly individual retail investors, do not have high quality deal flow to get consistent alpha in the space. The next one is geopolitical risk. Geopolitical risk is the idea of foreign policy decisions or domestic policy decisions in countries that you're not native to impacting your investments. Geopolitical risk is less sensitive to the largest to most developed economies, but for smaller, more emerging market economies tied to a single commodity or industry are very exposed to geopolitical risk. I personally think that geopolitical risk is the most overvalued form of risk. Every geopolitical catalyst is pricing in some possible left tail risk of World War III happening. And total war is really the only time where betting on geopolitical risk paid off was between World War I and World War II in the long run. Every other time, the geopolitical risk has gotten overbid, and there's a lot of money to be made from betting against geopolitical risk. So when it comes to geopolitical risk, the market is pretty efficient when it comes to this. Short of a major total war, it's very unlikely that you're going to make money trading large major country equity markets based off of geopolitical risk. Level 5, the ostrich in the sand effect. The ostrich in the sand effect is kind of what my main criticism of private equity is. It is the idea that people will ignore things that are not marked to market. Example of this would be like private credit or private equity or vol selling strategies in general. Risk that is either happening or that you are being compensated to be paid for, but is not really being recognized immediately. Like example is private equity. With private equity, say for example, and I wrote a long piece on my Substack about this very effect. You can subscribe to my Substack if you want to check out the full thesis of it. But the idea here is, say if you're an institutional manager and you buy a private equity fund, the private equity fund does not have to mark to market. When you own a publicly traded stock, you have to mark to market. So like if the stock you own goes from $100 to $99 in one day, you have to, on your NAV of your portfolio, which is net asset value, you have to say your net asset value is now $99. Whereas with private equity, even if all the publicly traded companies in your sector move down 1%, you have no obligation to mark down your portfolio. So while the publicly traded basket of technology companies is at $99, your private equity fund is still at $100. It's the same. If the market swings up, the private equity firm, it's up to their discretion to determine whether they mark that up or not. Usually they will mark it up. They tend not to mark down unless there's a liquidity event forcing them to, whether it's the end of the vintage, the company they invested in goes bankrupt or gets acquired at a lower take under, or some other catalyst that forces their hand. The Sharpe ratios are much higher than, say, a small cap value portfolio, even though it's the same exact risk and similar type investments as the small cap value portfolio. I call it the ostrich of the sand effect because institutional investors, instead of demanding a discount for lack of control and lack of liquidity, they're actually paying a premium to stick their heads in the sand and not acknowledge the hidden volatility that is there. This is a big problem that's led to overallocation of private assets. Even smaller advisors doing this for individuals do it because since private equity is less liquid, it's harder for clients to transfer their account to another advisor because it's stuck in this illiquid asset that may not be transferable to another advisor or if they want to self-direct it to their own brokerage account. So That's another ostrich in the sand. It's like, well, illiquidity is supposed to be something that investors historically want to avoid. But now, due to certain incentives, there's a lot of them that are seeking it. The next thing I'm going to talk about are options as hedges. Options for wealth managers are generally used more to hedge exposures more than for speculative purposes. So say, for example, you're a wealth manager and you have a client who's invested in a lot of stocks or has a concentrated position in a large stock due to them buying it a long time ago and it's appreciated way more than everything else. You could sell it and diversify that way and take a big tax hit. You can sell your portfolio if you're bearish and also take a tax hit and miss potential upside. Or what you can do is hedge it through options. I'm not going to really go into specific hedging strategies because different vol environments have different specific hedging strategies you would use for this specific example. Use the options market to hedge potential downside risk in a way that's probably more cost effective than taking the tax hit for selling, or can keep most of the upside of the market while having some real protection of the downside if things go bad. And then the other really kind of bonus, if you're overly defensive, you can also hedge with calls. Like if you have a very defensive bond portfolio, but you still think there's a chance the market rips, but your client doesn't want to take that risk due to their stage in life or their risk attitude. Instead, you can maybe buy upside protection. So you can get some of the upside of the market without really risking the core positions of the portfolio. So when you look at options more from a longer term wealth management and then trying to buy whatever's the most juice for a short term trade, they're often used for hedging. Just as a disclosure, I am the partner at a wealth management firm called Spearhead Advisors, and nothing in this is investment advice or any promises for better returns. I am not a tax advisor and I'm not an estate attorney. So if do not use this Iceberg as advice about how to optimize your taxes, your estate planning needs. If you have any specific questions about anything involving wealth management, feel free to contact me directly, either via email or through the contact form in the pinned comment or the description, or through my website, nickpardini.com. And then the last thing is deferred compensation. Deferred compensation is a way that a lot of employers pay high-paying executives for two reasons. One, it defers tax liability. Like if you can keep the income under a certain tax bracket, but you have deferred compensation so they get paid into their retirement, that could be a source of tax relief for the employee. The other benefit of deferred compensation is its incentive for the employee to stay with the company and not retire early or change jobs, because a lot of that deferred comp has to be vested. If you're not there for the whole time, whether it's stock or cash, to be fully vested, the company does not have to pay that compensation, versus if they had to pay up front, the money's paid up front and they don't have the same kind of protection from attrition. And deferred comp strategies are often used to help manage the wealth of high-paid executives in a variety of fields. A controlled foreign corporation is a foreign company, and they're usually at places like Singapore or the Cayman with very low income tax rates. U.S. shareholders owning at least 10% of the company each. It doesn't have to be U.S., but this is a mostly an American audience, so I'm going to use an American example. That collectively controls more than 50% of the voting power or value, are subject to U.S. tax rules designed to prevent tax avoidance strategies through offshore entities. Before you had a lot of legislation on controlled foreign corporations, these were a common way for the wealthy to avoid taxes. But as the tax authorities have gotten more aware of these kind of things, it doesn't really work as well as it used to. Different countries have different rules on this. The benefits of a controlled foreign corporation for a high net worth individual is they can keep a lot of their assets overseas and held through the corporation, and they pay the corporate income tax on the local jurisdiction, and they can buy all their investments through the controlled foreign corporation. They can buy certain personal assets and make them business assets outside of U.S. borders. As soon as you bring any assets or proceeds into the U.S., you have to pay U.S. taxes on the assets and or the proceeds. So in theory, the reason why you would want to do this is that you can pay the lower corporate tax in the foreign jurisdiction and not have to pay U.S. income tax until you bring the money back into the country. And if you never bring the money back into the country, you never theoretically have to pay taxes. And note, I am not a tax advisor. Please do your own tax research or find a qualified CPA to help you. And I don't want you guys all setting up random foreign companies with the hopes of avoiding taxes. There are certain rules to this because, again, it's changed. One, if it's a passive income such as dividends, interest, and rent, given the fact that the U.S. is one of the few countries in the world where you're taxed on worldwide income, no matter where it's sourced at U.S. rates, you're still going to pay U.S. income taxes. This might be a better strategy for countries that have either territorial tax structures where it's based on the country of residence and not solely on your citizenship. So, but for Americans, they don't really get privileges when it comes to that kind of thing. And then, the other thing is that when it comes to these, you can accumulate income offshore and delaying tax liability. The other things that are not as popular as they used to, in addition to the IRS becoming more aware of these kind of things, is that the U.S. has slashed corporate taxes. Pre-2017, the U.S. had some of the highest corporate tax rates in the world, 35%. And now they're down to 21%. And there's potential tax cuts coming under the Trump administration, particularly for companies who primarily make or sell their products in the United States. So the difference between the tax you pay in the foreign corporation and the tax you pay in a U.S. corporation is a lot narrower. And because the gap is narrower, it makes this tax avoidance strategy less convenient, especially as there's other options such as private placement life insurance, which may be more efficient and effective at doing a similar thing. And also note, I don't really have any involvement in the insurance industry professionally. Yeah, and also the risk of not complying with these things results in really severe tax penalties because I don't want to set the precedent of evasion through foreign companies. The next thing I'm going to talk about is dual citizenships or citizenships for purchase. If you live in a country that's geopolitically not so stable, or you want protection in case if your country becomes less stable. One way to hedge yourself is through a foreign citizenship. These can be very valuable if it's in a country that has either a different geopolitical stance, a better reputation, or a stronger passport. And it allows you also to have dual citizenships, allows you to buy assets in countries that are only allowed for their citizens. So, for example, there are certain parts of Europe that only European Union citizens are allowed to buy real estate. So if you're an American citizen with no EU passport, you're out of luck. Whereas if you do have an EU passport, you can participate and own these properties. And there are many other types of those examples around the world. Or if you don't like the tax situation in your country or have a political reason to economically migrate, you can renounce your citizenship and have a new one and not end up as a stateless person. There are certain countries, mostly in the Caribbean, that you can buy citizenships. And then there are others that you just have to be creative and maybe use your heritage to get citizenship. But for most ultra high net worth individuals, dual citizenships are a lot more accessible than it is to us normal folks. So that is an option that people use as insurance against their home country. The next thing I was talking about is FATCA and exit taxes. FATCA is a policy that was passed in the wake of the financial crisis, which basically requires every foreign bank to report any U.S. citizens' holdings of their foreign assets. This is what killed the Swiss bank account. Back in the day, a lot of people would have Swiss bank accounts and use them to hide money for either asset protection reasons or for tax avoidance. But then when FATCA came along, the Swiss banks were kind of forced to comply with the US's disclosure standards. And eventually a lot of other countries caught on. The secrecy part of the Swiss banking system was very compromised. And a lot of the tax havens, beneficiaries for Americans having assets in tax havens all over the world, went away overnight. FATCA made secrecy harder. Now there's international equivalents that other countries have adopted too. So there's also the exit tax. Exit taxes are for a lot of countries that have them to prevent wealthy citizens from gaining a citizenship elsewhere and not paying tax. The US passed one in the Clinton administration in the 90s, and several other countries are considering doing similar moves. When you leave a country, you have to pay a tax on all your assets, especially assuming you sell everything, and pay a long-term capital gains tax rate for most of these countries. And so as a result, you end up getting stuck with, I'm going to give some examples of major countries with exit taxes. The US has an exit tax. So US residents who've lived in the US for 8 of the last 15 years have either a net worth exceeding 2 million or an average net income tax liability above a specified threshold, which is 190,000 for 2024, have to pay an exit tax. It's essentially an unrealized capital gains on assets if they were sold at a fair value today. So it's we're going top federal tax rate, so 23.8% exit tax if you want to renounce your citizenship. France is proposing one. Individuals who've been French tax residents for 6 of the last 10 years and move their domicile outside of France, those who hold either equities that exceed 50% of their net worth and or greater than 800,000 euro in value have to pay an unrealized capital gains tax upon exiting the country. It's not on all their assets, it's just publicly traded equities. Germany also has an exit tax for people who've lived in Germany for more than 10 years. It's unrealized capital gains. It can be deferred if you move to another EU country. So it only really applies if you leave the EU. Spain also has one for assets over 4 million euros, 25% unrealized capital gains. It has one as well. It's a similar thing. Denmark, Netherlands, Italy, and Norway. And Norway is particularly the most pernicious because they have very high capital gains tax rates, for one, and two, they have wealth taxes. So if you're over a certain net worth, you have to pay 1% of your net worth to the government every year. So it's like having a financial advisor without them actually helping you get investment returns. When it comes to this, in Norway, if you don't leave, that 1% compounds every year. You have to sell assets and pay capital gains on that. You have to sell also 2% of your assets every year, or at least 1.5% to cover the capital gains on the asset you're selling to cover the wealth tax, unless you generate enough dividend income. You have to pay every year. If you're in the country for more than 30 years, your family's going to be at risk of running out of money as that keeps going. And so a lot of Norwegians are actually leaving the country and saying, forget it, I'm just going to pay the exit tax because I eventually run out of money through the wealth tax anyway. Exit taxes are kind of a pernicious thing, but they're very politically popular because the people who are renouncing their citizenship are a very small percentage of the vote, or not. And once they do renounce, they don't vote. So they don't really have much political power or influence. So they're an easy target for politicians. And there's really no advocacy group who's really representing the expat who doesn't want to pay taxes in America anymore. The last thing I'm going to talk about in this tier is Michael Green. So who is Michael Green? Michael Green is a CIO at a firm called Simplify Asset Management. He has had one of the most notable arguments against passive investing. His thesis really breaks down into 3 points. Passive investing disconnects prices from fundamentals. As passive becomes a bigger share of the investment pool, there are less active investors looking to find true fundamental value for assets. And since the flows are just everybody's monthly 401k contributions coming in and blindly buying an index, the stuff that's the biggest names in the index are going to get disproportionately amount of capital, and the stuff that's not in the index or the smallest holders in the index are going to just get disproportionately less capital. So it skews valuations, not really based on fundamentals, but more just on who's already has a bigger share of the float. They automatically buy stocks in proportion to their market cap, regardless to fundamentals. This creates a reflexivity kind of in the Sorosian way, where higher prices attract more passive flows, which drive prices up. Then there's the concentration problem. There are really only 3 big passive ETF managers, BlackRock, Vanguard, and State Street, which control 40% of the stock market indirectly through their ETFs. I had a video talking about why there's no grand conspiracy of them controlling companies. But there are other issues with this concentration apart from what conspiracy theorists are concerned about. This reduces the diversity in decision-making and creates corporate governance problems. And the third part of his thesis are liquidity risks. Passive strategies really don't provide a lot of liquidity during market turmoil. Active managers are usually the ones who provide liquidity because active managers are usually are more willing to buy stocks when they're cheap or falling a lot because it seems like a good opportunity. Whereas passive, it's the reverse. They won't buy the cheap asset because it becomes a shrinking percentage of the index. And so therefore selling begets more selling and there's really no bid. So when something does have a big downward move, it's more likely to perpetuate and go deeper than it would be if there was a more balanced market between active and passive participants. During a sell-off, passive investors are forced sellers because if the ETF flows turn from positive to negative, and that might just happen just due to the aging of the baby boomers and less people contributing to 401ks, then no matter what if the company's earnings or fundamentals are improving, the stock still might go down just due to flows. And you can also see bid-ask spreads widen. And the last part is volatility suppression and the self-reinforcing nature of this problem. Like passive flows dampen volatility because it rises all boats and it reduces dispersion in prices between specific stocks in the index. And it creates a perception of the stability and makes things seem like they are safer than they actually are. And if a reversal happens, then the volatility can unwind very quickly and lead to extreme dislocations in the market. It's like his argument is that passive is a ticking time bomb where everybody's just doing the same thing, hoping that everybody will keep doing the same thing. And the 401k flows will just keep the party going indefinitely. And however, if that anything causes this perpetual reflective motion to change, it could lead to a broad blow up in the market as you see capital flow out of the indexes versus in them. And we've seen this example on the sector level. Like when ESG was really popular, you just saw relentless selling of energy stocks. Even though the energy stocks seemed to make more profits and fundamentals of the companies were relatively solid, even after oil prices bottomed for a year after that, energy stocks seemed to sell off because the ESG flows were telling a lot of institutional investors and a lot of ETF passive holders, like, you need to lower your holdings in energy because it's not ESG compliant. And so that's kind of an example of how this happened on a more micro level. But what Michael Green is concerned about is that it could happen more on a macro level. And now we are at the final level, where it's like the really weird stuff that only applies to people in really niche situations. A lot of advanced wealth managers do. The first one is 10b5 and Rule 144 selling. This applies to executives or large shareholders who own more than 9% of a publicly traded company. They don't follow the same rules in terms of buying and selling stock that you or I would. They have more restrictions for sound reasons. Executives tend to have more intimate knowledge of companies, being able to trade freely. It can help cause a lot of unfair market distortions and increase insider trading risk, and also reduce the integrity of the capital markets. There are rules to restrict executives for how they time purchases and sales of assets. The 10b5 is the rule that says if you are one of these large concentrated shareholders, you have to have a pre-scripted plan of how you are going to sell your shares so that it is like either randomly distributed or you are going to sell a certain amount of shares at a fixed period of time. And there's a certain level of limits to how much that can be revised. And the reason they do this is because you don't want people selling right in front of a bad earnings report or doing purchases right before a good earnings report, or just using their knowledge of the company to time their purchases or sales. And so and it's usually done by a fiduciary to help them exit out of these positions, and they don't tell the shareholder what they're doing once the plan has been sent. That's what 10b5s are. And then Rule 144 is this idea you have limitations on how much shares you can sell if you are one of these concentrated players. It would set a bad precedent if companies, as soon as or after the lockup period, which is a time where nobody's allowed to sell shares after the IPO, just dump all their shares right away. The stock tanks as a result for that, and that causes problems with integrity of the capital markets. So there are regulations that prevent this kind of behavior from happening. And that is what Rule 144B selling is. It's basically saying how much can a concentrated holder sell in a given period of time. And there's two conditions. The first one is a 1% outstanding shares for the issuer, or the average weekly trading volume over the past 4 weeks on all exchanges where the stock is listed. This applies to affiliates, which are either insiders or people with large enough positions to be considered controlling, or those who are related parties to those groups. A lot of non-affiliates might be subjected to volume restrictions as well if they've held the stock for more than a year. The rule is that you cannot sell either 1% of the value of the company or the average trading volume of the past 4 weeks on all exchanges where it's listed. And the reason why they do this is they don't want concentrated shareholders to dump shares. And it's also why you see a lot of people who are trying to get rid of their stock to be aggressive in promoting trading activity, because the more trading activity, the higher the volume, which means the more you're allowed to sell under 144. So that is another kind of thing to watch out for wealth management. Network access is a perk that a lot of the larger wealth managers can offer that smaller wealth managers or people can't get themselves. If you are a big wealth manager, one of the perks you might offer, in addition to the investment services that you provide and banking needs, is access to your network. Maybe since you have such a diverse pool of ultra high net worth individuals as your clients, or your clients are friends with certain people in high places, you could leverage that network to help your clients, whether it's to reach out to people for business reasons, political purposes, or access to a competitive elementary school in New York. The network effect from having a large group of well-connected clients, you can connect the people who don't may know each other, but can use each other's help and offer that as a perk for your business. Yeah. The next one is the great taking. I did a whole video about it, but it's the idea that a lot of assets that you think are safe under a custodian may not be so safe, and that the whole investment industry and the global capital markets are not really prepared for such an outcome. And there's an interesting book written by David Rogers Webb, which goes into the details about this. If you want to know more, watch my video on the great taking. The next one is no one is prepared for the bear, which means that nobody is really sufficiently prepared for a bear market, even professional advisors. There are some professional advisors who are willing to stick their nose and hedge, either with the options market or being more defensive, rest of the wealth advisors out there or the index, or even some like hedge fund managers are outright short. But oftentimes you can't do this sustainably because of career risk. That kind of defensiveness in the short term can lead to underperformance. And because of that, a lot of your clients may not stick around because they're like, oh, you're not getting as much returns as either the index or these other advisors who are willing to take more risk. And because of these types of career risk incentive, a lot of institutional investors are more skewed to taking on more risk or risk in line with the index so that they do not get left behind. As a result, positioning never tends to be defensive enough when it's most needed to be defensive. And as a result, nobody's really prepared for the bear market. And I think you should look for, when you do find advisors, one who is willing to be prepared for the bear market, even if it may hurt their firm's financial success in the short term. That's really what you pay advisors to do, being willing to turn before the crowd does. By the time your typical advisor is concerned about the bear, we're already in the middle, if not the end of the bear market, and that's not the time to be worried about the bear anymore. So, yeah, and that's generally no one's prepared for the bear. And the last several years, having only one real bear market that wasn't very long, 2022, since you've had almost a generation of very little downside price volatility, which has made people even less prepared for the bear. And then the last one is advisors cannot advance your social class, but really maintain it. So you're not going to get rich from managing money or from your stock portfolio unless you do it for a living, start a hedge fund, or if you are a really good stock picker and find a lot of high quality investments, you might be able to, but again, you're doing that on a professional level because that requires professional level diligence to do that kind of trading performance in the long run. So those who are hoping to hire a wealth manager to advance them up a social class are going to be sorely disappointed. Really, what they do is help you maintain your social class. They create wealth trust structures that prevent your heirs from squandering the fortune. They invest in a prudent and fiduciary manner that helps you have returns that allow you to catch up with inflation and maintain your social class throughout your life. That is what you hire an advisor to do. Or your goals, if an individual investor, you want to do this yourself, your goal as an individual investor is to maintain your class standing, maybe get a slight improvement of your living standards, but probably not enough that you're going to move up a class solely just through a long-term investment plan, especially if you're starting with a relatively small amount of capital. Overall, this is the iceberg of wealth management. Let me know if you have any specific questions about any of the topics I talked about in any of these chapters. And if you want to contact me directly, feel free to reach out to me via email or the contact form. Thank you for watching. Just as a disclosure, I am the partner at a wealth management firm called Spearhead Advisors, and nothing in this is investment advice or any promises for better returns. I am not a tax advisor, and I'm not an estate attorney. So if you do not use this iceberg as advice about how to optimize your taxes or your estate planning needs. If you have any specific questions about anything involving wealth management, feel free to contact me directly, either via email or through the contact form in the pinned comment or the description, or through my website, nickpardini.com.